Good afternoon, everyone, and welcome to our discussion on the impacts of the 2024 election on our tax landscape. This is a time when many of us are anticipating significant changes on the tax policy front, and our tax team here at Cherry Bekaert is here to help. My name is Brian Moore, and I'm the National Managing Partner for our tax practice at Cherry Bekaert. Thanks for joining us today as we hear from some of our team on the anticipated effects of a new president, Senate, and House of Representatives, and how you can start planning for the future. During our program, we'll be examining the key outcomes of last month's election and the expected impacts on legislation. We'll examine potential shifts in policy under the upcoming administration and also talk about the Tax Credit and Jobs Act provisions set to sunset in 2025. I'm pleased to introduce our speakers for today, Brian Dill, Martin Martinez, Ron Wainwright, and Sarah McGregor. And with that, I will hand it over to Ron to kick us off and get started.
Thank you, Brian. And it's great to have you all with us today. We are excited about the next 50 minutes to share our thoughts as well as our strategic insights with respect to the Tax Cuts Jobs Act of 2017 and what we may be facing given the election results. What we'll cover today is ultimately the election results. We'll talk about potential legislation. And then to my comment, we'll focus on expiring and potentially extending TCJA provisions. My colleagues, Sarah McGregor, will talk about individual implications and pass-through entity tax. And Martin Martinez, our head of corporate tax for the firm, will talk about the corporate tax updates. And then we'll round it out with Brian Dill, our international leader, with respect to international tax updates over the next 2 years. So this brings us to our first polling question. How did you hear about this webinar? A Cherry Bekaert tax advisor, an email from Cherry Bekaert, friend or colleague, Cherry Bekaert alumni, or a social media post. And I'm pleased to tell you that we have over 700 in attendance today, as Brian commented on the trifecta occurrence of the election, which we'll dive into, as well as what we should expect over the next 2 years, maybe 4 years, from a tax legislation and policy perspective. We'll give you a few more minutes to complete that poll, and then we will begin to talk about the election results and the implications thereof. Excellent. So let's go ahead and begin our presentation today and talk about the election results and what occurred in early November and what those implications can be and likely will be in regards to tax legislation and tax policy. As we all are likely aware, we have a new president, President-elect Donald Trump, who will serve in his 47th presidency, having been elected as the 45th president of the United States. On the Senate side, the Republicans won the Senate with a majority of 53 seats, in essence holding flipping the Senate. The Republicans won 4 seats while the Democrats lost 4 seats. And the implications thereof we will discuss as to changes in the Senate Finance Committee chairmanship, as well as the majority in that very important committee, which begins the process of tax legislation. On the House side, it did take about a month for the ultimate House elections to be called, but on December 4th, the final California House of Representatives race was called, and the Republicans stayed at 220 in the majority, and then the Democrats have 215. And yes, it is a slight majority, whereby the Democrats won 1 seat with the Republicans losing 1 seat. What it looks like just from a map perspective is President-elect Trump won with 312 electoral votes to VP Harris's 226. We always like to share this graph from the visual perspective of where the country is from a red perspective and where the country is from a blue perspective. From a Senate perspective, that was a flip, as we discussed, with the Republicans now holding majority at 53 and that is without the vote of now VP-elect Vance, with the Democrats having 47. And again, a visual display and looking through the 53 and 47 in regards to the Senate. So a more majority, knowing that the majority is 50 seats, and as we'll talk about budget reconciliation, the importance of 51. From a House of Representatives perspective, again, the race was called late, about a month after the elections were held on December 4th, where you see the Republicans have a 220, 218 is the majority, and the Democrats to have 215. Again, a pickup of one on the Democratic side and a loss of one on the Republican side. And this will be very important as we begin to look at what potential legislation there could be and what is the implications from a tax policy perspective, with the ultimate result being what is often referred to as the trifecta, where one party holds the White House, a Republican, obviously the House, which continued to stay Republican, and then the flip of the Senate with a thin majority there and the Senate as well. So what does this mean from a tax policy perspective? And what should we expect over the next year, maybe 2 years until the midterm elections with respect to what the President-elect Trump would like to accomplish in his 47th or his presidency, along with the sitting of the 119th Congress? So these are the highlights of President-elect Trump's tax plans. From an individual income tax perspective, and he cited this on the campaign trail in numerous instances, he would like to make the expiring individual income tax cuts from his key mark legislation of 2017, being the Tax Cuts and Jobs Act. He'd like to make those permanent. The majority of those sunset at the end of 2025, and Sarah will go into more detail on that. He does want, with a cap, from what we understand, to reinstate an unlimited itemized deduction for state and local taxes or state and local tax payments. Or again, set a new cap. Remember that the current cap is $10,000, but there has been a number of comments made on the campaign trail where that cap could go up to $50,000. But let's recall that those are in blue states, so those may be a little bit more difficult. And as we'll highlight, that one estimate alone from the General Accounting Office, if we did make the SALT cap, it would be a cost of about $1 billion. There were also campaign statements made towards the exemption of Social Security benefits from taxation, exempting tips from taxation, and exempting overtime pay from taxation, being the kind of the key individual income tax provisions or potential policies that President-elect Trump would like to see. There was a lot of what are called pay-fors that were cited on the campaign trail by President-elect Trump, specifically in tariffs and trades, whereby an imposition of a universal baseline tariff on all U.S. imports of 10%, upwards of 20%, could occur. President-elect Trump has indicated that will be done, and he is allowed to do that through executive action, and he plans to do that when he is inaugurated in the afternoon on January 20th. And then there has been a lot of discussion about the imposition of upwards of a 60% tariff on all U.S. imports from China. And again, that would likely occur the afternoon of January 20th. So when we think about control, as we discussed, we certainly have the trifecta, as it's referred to, and President-elect Trump has indicated, coming out of a strategy meeting in Mar-a-Lago, that the Tax Cuts Jobs Act and extending those provisions, not necessarily permanently, but potentially for a period of 4 to 5 years, is a top priority. In fact, it was ranked in his policy position paper as one of the top 5. Now, there will be a lot of discussion around addressing President-elect Trump's campaign promises with his current political momentum. Obviously, there will be a lot of discussion in the context of that, however, is what is the impact of the overall deficit of the United States, and how does that work through budget reconciliation, which we'll talk about, which is a very important aspect to pay attention to from a policy perspective. We also, as highlighted, know there are very narrow margins, not only in the House, but also in the Senate, which does give those individual members, whether that be a senator or whether that be a House member, candidly a lot of sway if you were in the Republican Party, if you were to look for a continuous GOP vote being all Republicans. But ultimately, there will be, as I said, a real determination of how much are the Republicans willing to add to the current deficit of approximately $36 trillion. I mentioned the pay-fors. So technically, what is a pay-for? It refers to a budgetary measure used to offset the cost of proposed legislation in order to achieve what is referred to as a neutral or a reduced fiscal impact. And that will be very important as the GAO, the General Accounting Office, in essence, scores the tax legislation over a 10-year period, which is a requirement. Ultimately, what does this do? It helps manage the scoring of the bill by CBO and GAO, which ultimately evaluates the financial impacts of those legislative proposals. And that will ultimately determine what are the members and how much sway do those members have, depending upon their specific state and who they represent. But it remains to be seen what the ultimate effective date will be in regards to the statutory tariffs. There's a strong belief that they will take effect immediately. And then there has been a lot of discussion around the repeal of the Inflation Reduction Act, or what are often referred to as the green energy tax subsidies. A comment that President-elect Trump has said, drill, baby, drill, or drill, 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 obviously taking the alternative energy back to more of an oil and gas implication. So the addressing of the state and local tax issue will be a challenge, as I mentioned, due to the narrow congressional margins, the influence of those members from New York and California specifically, which again were blue, and the impact of the CBO cost estimate of $1 billion is going to be something very important to pay attention to, and maybe one of those provisions in the Tax Cuts Jobs Act that ultimately falls out of any potential legislation. There's also a lot of discussion, which Brian will cover, in the international provisions around ending what is referred to as the OECD, or the Organization for Economic Cooperation and Development, in essence, Pillar 1, reminding that we have not adopted Pillar 2. There could be a strong retaliation against digital services tax if that were to be considered. And then ultimately, from an international perspective, I would expect that there will be a fight against what's referred to as the undertaxed profits rule under Pillar 2, reminding us that we did not adopt Pillar 2, but that does have a push for GILTI, which Brian will address, as well as has an impact on the tariff environment. So I mentioned budget reconciliation. So this is ultimately the path forward, which is the most straightforward path based upon the trifecta or the Republicans in control. So a lot of, I'll say, misunderstanding occurs when you begin to think through what is budget reconciliation. And this is very important. We want to spend a few minutes on this. So what it means is that the Republicans, to pass tax legislation, it allows the Senate specifically to pass with 51 votes, as opposed to what's normally referred to as the supermajority of 60 votes. So clearly they have 53 currently, and that is without, if you will, if you had a few Republicans fall off that count. Ultimately, the VP Vance's vote, which would take them to 54. However, it only applies to legislation that affects the deficit. And that's my comment toward it's very important to where the Republicans will ultimately find themselves in regards to how much debt they're willing to take on from a U.S. deficit perspective. And also, there's a provision called the extraneous provision, which basically says you can't take on, or a provision can't be extraneous in nature under budget reconciliation. It also cannot include changes to Social Security, which was a debate on the campaign trail as to would there be a consideration of changing Social Security. So take that off the table when you think about budget reconciliation. Again, it cannot increase the deficit outside the 10-year budget window. That is obviously the score from a CBO perspective, as well as the General Accounting Office perspective. However, To go through budget reconciliation, it's important to understand that House and Senate concurrent budget resolutions, or in essence, what starts in what are referred to as the originating budget committees. They must include reconciliation instructions, or in essence, directives that tell the tax writing committee of the House of Representatives or the Senate Finance Committee how much they can increase the deficit in their tax legislation. So this will be something that you must pay very close attention to, and we'll continue to update you on in our thought leadership. Again, a summary of what is budget reconciliation. It is simply a special legislative process in the U.S. Congress. Both the House and the Senate must first pass an identical budget resolution in regards to the budget as a whole. And then it has reconciliation instructions to each committee as to what they can and cannot do in regards to an overall budget perspective. These instructions are very direct and very specific to the committee when they're drafting technical tax language, which is ultimately aimed at achieving certain spending or revenue targets. That'll be the first discussion or trifecta that will need to occur. Now, just to give you a quick update, there's already a meeting that's been planned for this weekend, now being led by Senator Thune, who replaced ultimately Senator McConnell, is now the ranking senator in the Senate. Also, we will see Senator Crapo there, who now chairs the Senate Finance Committee. Again, that was a flip in the Senate. And then, of course, Speaker Johnson will be there along with Jason Smith, or Representative Smith, who chairs House Ways and Means. That meeting is ultimately this week, and that will begin those, along with President-elect Trump, as to what is the strategy, what's the policy perspective that we want to achieve. Because coming out of the original strategy session in Mar-a-Lago, there was a statement that was made that President-elect Trump would like to see tax legislation no later than the 4th of July. And some have released information that he'd like to see that done no later than the end of April, with the thought process that any tax legislation, i.e. extension of Tax Cuts Jobs Act, et cetera, would be a retroactive provision into January 1 of 2025. So the sooner they can get to it, the sooner they can get through budget reconciliation, the more likelihood of January 1, 25 or that retroactive date. There is precedence that that could occur. Again, ultimately, this allows for faster passage of bills, which is what President-elect Trump has indicated and sent to his leaders in the House and the Senate as to what he wants to accomplish. However, remember that it does limit debate as well and prevents what's often referred to as a filibuster in the Senate. So these are some of the parliamentary procedures that are important to pay attention to when you think about reconciliation or budget reconciliation. It does allow significant policy changes, which is ultimately what President-elect Trump wants, with a simple majority vote, as we highlighted, of 51. The Republicans control ultimately 53, and with the vote of VP Vance, 54. As an example in comparison, we saw former VP Harris vote the final vote on the Senate side to pass the Inflation Reduction Act. So this is a very important around the simple majority vote of 51, knowing the Republicans control 53 on the Senate side, as well as control the House. Reconciliation is often used, if you looked at it historically, to make major changes to what are referred to as mandatory spending or taxes as well. So I put a couple slides in here just to cover highly, and you can, or a very executive summary of what the process looks like and the key points. Ultimately, you can focus in on what is often referred to as the Byrd Rule if you're not familiar with it. But basically, it's a strict rule which was named after former Senator Robert Byrd that limits what can be included in a reconciliation bill by ensuing only provisions or ensuring only provisions which are directly related to spending or revenue provisions. So a very specific process here that the Republicans will use and must use to ultimately go through a budget resolution, which is the first step when it's passed. Committees draft the bills, budget committee compiles bills, then you have the floor votes, House and Senate gets pushed through to a conference. That's where the delegates basically reconcile, as it's referred to. the provisions of the floor vote on the House and the Senate, and then ultimately through the reconciliation, i.e. budget reconciliation process, it goes to the president for signature. So this is the process that will be going forward here. As I mentioned in the context of my comments, this is very important to focus on these two individuals. So Chairman Mike Crapo, a Republican out of Idaho, is the new chair of the Senate Finance Committee. Very important position. Obviously, that committee is now Republican controlled. So if it were to go to a straight party vote, the Republicans on the Senate side having not only the majority of the total Senate, but also the majority of the Senate Finance Committee can really pass, if they stay in the majority from the standpoint of all their votes are in the majority, around getting it out of the Senate. And then, of course, Chairman Jason Smith has been the chair of the House Ways and Means Committee. This is important to note from the standpoint that in February of 2024, under Speaker Johnson as well as Chairman Smith, who's a Republican out of Missouri, the GOP began to work on passage of the Tax Cuts Jobs Act in 2017. And so there have been upwards of over 100 plus committee meetings from February through really at the end of August and September as to what the House saw, believing they would maintain control as to what would need to happen, what were the provisions they would focus on in regards to extending or making permanent the Tax Cuts Jobs Act of 2017. So this is important to understand, is what is the ultimate TCJA extender cost? So this obviously is a provision that ultimately comes out and they score the bill. This is the budgetary impact of permanently extending the major provisions of the Tax Cuts Jobs Act, assuming it would be in 2026. But basically, it's about a $3.8 trillion cost. Now, I would like to turn it over to my colleague, Sarah McGregor, to take us through the individual implications as well as other implications underneath President-elect Trump. Sarah?
All right, thank you, Ron, for that. Now let's go ahead and flip to the first slide. What we're going to talk about is when we say extending the Tax Cuts and Jobs Act provisions that the Senate and House will have to wrestle with, what exactly are we talking about? This is also something we have to keep in mind, that most of our staff, seniors, managers who have started with us in the last 7 years only know Tax Cuts and Jobs Act. It's those of us who's been around longer will remember what the rules are from 2017, which if the Tax Cuts and Jobs Act expires at the end of 2025, then a number of these provisions will default back to where they were in 2017. So the left side of the slide, current law, means where we are right now with Tax Cuts and Jobs Act. The right side of the slide is in 2026, if Congress does nothing, this is what we'll default back to when TCJA provisions expire. So under current law, we have brackets, tax brackets for individual taxpayers. There's 7 of them. They max out at 37%. Under the old rules, the maximum bracket was 39.6, and they were not the same level for each of those brackets. The brackets were extended, so the 37% applies to a higher tax amount than it did today than it did when the 39.6 applied to a lower level of tax, topping out to that. So just to give you an idea, when we talk about those marginal rates, currently for 2024, for a couple filing, a married filing jointly tax return, that top bracket of 37% kicks in at $731,200. So pretty significantly high. If we go back to those old brackets, they will be updated for inflation, but it will come down, and that 39.6 will apply a bit sooner. Next slide. Personal exemptions. Some of you may remember we used to get a personal exemption. We don't anymore. If we revert back to the old rules, that personal exemption will come back into play. In 2018, it was $4,150 or projected to be. That will be updated for inflation. The standard deduction that was available in 2018, updated and estimated, is about half of what the standard deduction is right now. Those are not certain numbers, but just think in terms, if we go back to the old rules, it would cut the standard deduction in half. Next, please. The child tax credit. The child tax credit currently is $2,000 per child, with a refundable portion of $1,700, which is adjusted before inflation. And the phase out range, this is what's most important, I think, and impactful, is the phase out range currently for that credit doesn't phase out until you reach $400,000 of income for a married filing jointly couple, $200,000 for all other taxpayers. Under the defaulting back rules to pre-2018, what's going to happen is it's $1,000 credit. And sorry, that shouldn't say none is refundable, only $1,000 is refundable. Also, currently under TCJA, there is a $500 non-refundable credit for other dependents. So others living in the household that the taxpayers are providing for those dependents, there is a $500 credit. Old rules, no longer a credit for that. Okay. Next. All right. I pulled up an old version of the Schedule A itemized deductions to point out all the changes that will come back if we revert to the old rules after December 31 of 25. There was no limitation on the amount of state and local tax deduction available, so that SALT cap would be removed. The acquisition debt for a home to allow deduction of mortgage interest was at $1 million, and you could also get an extra interest on a $100,000 worth of home equity line of credit, regardless of what you spent the money on. Back then, cash donations were limited to only 50% of AGI instead of currently 60% limit of AGI. The Tax Cuts and Jobs Act limited casualty and theft losses to only those that are incurred in a federally declared disaster. So if someone stole your car, broke into your home, all of those things, if you had losses from that, those are not allowed currently as a deduction, only if property is damaged in a federally declared disaster. Miscellaneous itemized deduction. This is a big one that would come back into play. All those investment expenses and legal fees and job expenses that are not reimbursed, and gambling losses and hobby losses, and everything that falls into this miscellaneous deduction bucket would be allowed again, subject to the 2% floor. And then, however, at the end of the day, there is a limit and a phase down of overall the total amount of itemized deductions. And that too would come back into play. That's that phase down of roughly 3%. And that can happen for higher income taxpayers. All right, Ron? Alternative minimum tax. Many taxpayers currently under TCJA are not impacted by AMT. Why? Because there's not an add back to regular income for state taxes, because they're limited. There's no miscellaneous itemized deductions to add back. And so if we go back to the old rules and those deductions are allowed for regular tax, there will be an add back for those for AMT purposes. The other key point you'll see is on the exemption. There is an exemption allowed under the old regime and the new regime under TCJA and prior. However, the phase out threshold, it's what's important. You can see a really significant difference between where the phase out starts for a married filing jointly couple to phase out that $86,200 exemption versus where that phase out is for a married couple under the Tax Cuts and Jobs Act, which is $1,156,300 for 2024. So more taxpayers did not have to add back as many deductions because they weren't taking them, but they were also allowed to have more of the exemptions that were there than under the pre-TCJA rules. A couple of business provisions impacting individuals. The Section 199A deduction is something brand new created by TCJA. It would expire. The Section 461L loss on limitation on losses for non-corporate taxpayers. This is where business losses exceed a certain amount, certain thresholds. I call it tapping the brakes on the ability for individuals to deduct those losses. This actually doesn't expire until the end of 2028. It was part of a pay for a later bill that Ron had mentioned. By extending this from the end of 2026 or 25 all the way out to the end of 2028. So we'll have that. And I think I've got one more slide here. Right. How do these provisions impact family wealth? First, there was a creation of the Section 1400Z Qualified Opportunity Zone funds. There were some great benefits. Originally, there were 3 benefits for investing in a Qualified Opportunity Zone fund. One of those benefits has already disappeared, or is time limited and gone. The second one, deferring capital gain recognition and paying tax on that, will take place at the end of 2026. And then there's still the third benefit, which is if funds are invested in that opportunity zone for a full 10-year period, then additional profits will not be taxed on that. And finally, there was a question about the estate and gift tax lifetime exclusion amount. That amount for 2024 is $13,610,000 per person. 25, it goes up. I don't know why they didn't go ahead and say 14 million, but it's close enough to 14 million. If the Tax Cuts and Jobs Act expires, then this reverts back to where it was prior to 2018, which was 5 million. It will be adjusted for inflation, and estimates put it somewhere around $7 million if that happens. So a definite change to the threshold here for how much wealth can be moved to the next generation without creating additional estate or gift taxes. All right, I think that brings us to a polling question. Nope, we're moving on. All right.
All right. Oops. Ooh. Hi, Sarah. Thank you. My name is Martin Martinez. I'm a corporate tax partner in the Austin, Texas office. However, I actually reside in Houston. Today, I'd like, you can go to the next slide, please. Today, I'd like to discuss what impact the new administration may have on taxes in 25. I think we're all in agreement that tax changes affecting business will happen in 25. The question is, how quickly will they be enacted and how extensive will they be? The Tax Cuts and Jobs Act created some good opportunities for businesses, and under the new administration, we do expect the TCJA to continue. Because maintaining the TCJA, at least in my opinion, provides a little certainty with respect to tax planning and helping companies, better forecast and model what their operations are going to be. The big key items on the deck here are, lowering the corporate tax rate from 21% to 20%, and ultimately, maybe getting to a 50% rate for companies that are manufacturing in the United States, and for multinational companies with operations outside the US, bringing those facilities back. Other economic policies that may come out of this Trump White House include increasing production through the drilling efforts, as Ron had stated. There are a number of incentives available for oil and gas drillers and in the oil and gas industry in and of itself that are very beneficial, and from a manufacturing standpoint are very good for the U.S. economy. In addition to the opportunities available under the Inflation Reduction Act with respect to renewable energy policies. Based on my review of the current legislation, at least the proposals coming out, the most significant change that I've seen with respect to the Renewable Energy Inflation Reduction Act is going to relate to the mandate for the vehicles. There are a number of other energy credit incentives available under the IRA related to investment in qualified production manufacturing facilities, et cetera, that are quite beneficial and helpful for U.S. companies, especially corporate taxpayers and individuals that have we'll call active income that could benefit from investments in some of these projects that could be the discussion of a separate session. The Republican-controlled then we moved on. So the one thing I just want to reiterate is that we do expect to see some changes, and I think, as I understand it, and I think Ron illustrated earlier, the Republicans should get 2 bites at the apple coming in the near term, whether they're going to do everything in one bill or two, but something is coming, and it is just a matter of time. Now you can go on the next slide. Next slide. Okay. So just to reiterate on some of the items that have been discussed, the corporate tax rates at 21%. We do expect that to stay the same. It would be ideal to see some movement either down by 1% and especially going down to the 15% rate for at least some entities could create some significant tax savings and after-tax cash flow to help fund capital expenditures. I think Sarah's already discussed the 461L business loss limitation. We do expect to see that stay in place. And then I've already addressed energy tax incentives. We can go to the next slide. The one, again, there you go. We'll reiterate that the 199 Cap A pass-through deduction, we do expect that to continue. And then on the homeownership side, this was interesting on how they put this in this section. I do believe that this was put together in an effort to show that with some incentives available, we should be able to see some home construction increase due to the shortages that we currently see in the inventory. We can go to the next slide. So I think where we end up with respect to the changes, the majority of the changes, as you see, have impacted the individual side. There are going to be some material changes on the international tax section side that I'll leave to Brian. But where I generally fall in this area here is what opportunities do these changes create? And I think it's always good to consider, your entity classification. It's always good to do a refresh. Am I in the right business structure at this point? If I am in a pass-through entity and I'm being taxed only at a single level, but at a highest rate, do I want to consider switching to or converting to a C Corp? Can I avail myself of 1202 small business company stock where I might be eligible for an exclusion on the exit of a cap gain? So now is a good time to consider your entity classification and to see whether or not you're in your optimal structure. I also would say on the tariff side, there could potentially be an increase in the overall tax rate with respect to entities that are relying on feedstocks and products coming from foreign jurisdictions that are going to be subject to potential tariffs and inbound taxes. The bonus depreciation, even though it is still available, but it's going down on a 20% increment by year, there's always the hope that the new administration will consider, reversing this and making it 100%. That definitely has spurred at least investment in manufacturing property. Again, even though that's timing, cash flow is always king, and the use of that cash to fund other operations is quite beneficial. I will say that on the R&D side, of the one thing that I have seen that has created the most angst to clients has been the Section 174 deduction. Not to be confused with the 41 credit. The 174 calculation is quite extensive and it's expansive. It is the beginning point to the computation of the 41 credit, but what we've seen are some significant unintended consequences. Previously being able to capitalize, to expense versus capitalize and amortize, companies were able to defer cash tax payments up front. What we've seen are unintended consequences of being a taxpayer, especially if you had no pre-TCJA NOLs that you could use to shelter income with respect to 100% recovery versus the cutback and only being able to use 80%, which was further exacerbated by the 15-year capitalization and recovery under if you had international. So you effectively were whipsawed. So we're hoping there's going to be a change with respect to the treatment and full expensing again of these costs, because I do believe that it, at least in my opinion, has curtailed some of the investment activity that we have seen or research activity that we've seen in the past, because it can become quite detrimental. I would also say some of the things that I've seen in the transfer pricing space with respect to trying to mitigate this have been interesting, we will say, questionable in some cases. But I think that's something that going forward that Brian and his team can help look at as you're modeling this. I will say that the Inflation Reduction Act and the credits that still reside under current law should always be considered if you're a corporate taxpayer, given the fact that there's no material participation requirement. So to the extent that there are some unintended consequences of increased tax flow, cash taxes due, there is the opportunity to invest in projects that generate a credit, or even going on the portal, looking at the direct pay or transferability option that could actually give you a slight benefit. We can go to the next slide, please. So again, I think the takeaways from the changes in tax law or proposed changes in tax laws is always going to be a modeling scenario. It's always a best practice to create a current model showing what your expected cash flows are, what your operations are, and what your expected tax consequences will be, and then being able to be nimble enough to do changes on the, we'll call it ad hoc, so that you can see what a potential impact would be if there is a change in one of your inputs. We do a lot of this modeling in-house, and we can help you with building models that you could use. I would also say that even though it's not a part of this presentation, for companies that have applicable financial statements where they are preparing a provision, this is the perfect time that you could update your provisioning models so that not only are you computing your current tax consequences, you can also look at your total tax consequences and when these potential changes get impact on the rollout or the as you're scheduling out those deferred items and when they turn, what the impact would be. So again, even though it's very difficult to kind of have a crystal ball to see where you are currently going to be and what the expected changes are, I do believe it's always a best practice to continuously model what your current business situation is and being able to quickly adjust that model based on inputs. Next slide, please. As part of the research that I was doing in preparation of this presentation, I did come across a very helpful slide that was prepared by BNA that shows a complete list of all the 2025 TCJA expiring or changing provisions and where you would be able to find those if in fact you wanted to go and look these up on your own. So this is just informational. There's just nothing to review here. It's just a resource that you're able to look at. Okay, I guess we get to polling question 2. Were you aware of all the potential TCA changes in 2025? So A, yes, I was aware. B, a little, but this was helpful to learn. Or C, no. And with that, I will turn it over to Brian to discuss international.
Thank you, Martin. Let this go on for a few seconds. Let everybody answer. All right. International tax updates. I think what everybody hears in the news, at least what I see every morning, and it seems every evening, and what I read, tariffs, tariffs, and tariffs, and you see people getting on and saying tariffs are bad, tariffs should not be used. So I thought I would spend a little time today talking a little bit about how the administration views tariffs. And so before we get started, looks like we have a polling question number 3. So I'll take a step back. And how do you feel about potential changes in international tax? I feel good about proposed policies. I feel unsure, not sure. No, I'm not concerned. Seconds. We'll go from here. All right. Let's what I wanted to talk about, just to take a step back very quickly. We've heard a lot about tariffs. I thought I'd take a minute here, and at least from what I can tell and from what I've read, what are the economic rationale behind the tariffs and the potential tariff policies, and how could that fill in with proposed tax legislation and things coming on board in 2025, because 2025 is scheduled to be a very big year, and 2026 is even a bigger year in the international front. And so this next 12 months from a legislative perspective and a trade perspective is going to be critical, I think, from an international tax perspective. So if you go back, I don't know, let's go back 40 years, 50 years, and the idea of free trade and the WTO and the rules laid down under the General Agreement in Trade and Tariffs under GATT. I think what we had and what American legislators believed is that this was a policy towards free trade on a global basis. Well, I think what you're hearing from the new administration, and I think from other circles, is that they believe other countries on a global basis have gone around the WTO, have used policies outside of the original intent of the WTO and GATT, and it is incentivizing a flow of capital away from where it's most needed and most productive. And essentially, and I'll show you kind of how we believe this has happened, how over the last 5 decades that this has been harmful to American manufacturing, and it's actually had a shift of global manufacturing from deficit countries into the US to surplus countries like China and Germany that you hear about today. So what does that mean? Well, if you look at it from a global trade imbalance, the US consumer, makes up about 30% of the global consumption market. It's the largest by a long shot. So everybody wants to sell to the US consumer. So instead of entering into a tariff versus tariff and using bad trading policies, what countries have done is they have subsidized their local manufacturing and incentivized companies in those countries, new manufacturing, new tools, new everything, to essentially lower the cost of goods that they sell to the US consumer. And what that has done is that has put the US manufacturing on an unequal basis and driven up and has high production cost, which forces, or making an economic argument, that it calls for US manufacturers to outsource or move their manufacturing outside of the United States. At least that is the economic argument for why there is a global trade imbalance, and something needs to be done to bring back that into harmony. That the gains achieved in the first 20 years of free trade have been hollowed out in the last 20 years, and it's not achieving its original objective. And so something needs to be done. Let's push on to the next slide. So when we go into this, we've had a harmful, we believe that the message is we've had a harmful global trade with regard to manufacturing. There is also the thought from the incoming administration and the Republican side that a lot of the new global international tax initiatives are harmful, but this is going to be harmful to the US technology industry, which is the leading place for technology. And there are two main pillars that we continue to talk about: Pillar 1 and Pillar 2. Pillar 1 is essentially changing where a company pays tax. Think about, you're a technology company in the US, and that you're located, your employees are located here, you design and develop your technology here, you think you should pay tax here. Well, on digital products, Pillar 1 is trying to shift that to where you may sell those digital products, even though you never touch that country, to where you would pay tax in that foreign country on your profits that you make here in the US. Pillar 2, I think we've all heard about it in the news for the last 6 years, 8 years, is a global minimum tax. And we've settled kind of on that 15% rate. So talk a little bit about that. Let's go to the next slide. So let's talk about Pillar 1. How would that work from a pictorial perspective? You have a U.S. technology company. It makes $100 billion in revenue, profits, and this is just a pictorial. This is not how it would actually work. It's way more nuanced than this. But let's say their profits are 25%. But let's say this U.S. technology company sells their digital goods or downloads to country A consumers. So that is 15% of global sales would be going to country A. So essentially, what country A would argue is that a portion of the profits earned here in the US should be paid to country A, and country A has a right to tax that. That is essentially the argument of Pillar 1, is that it should be a consumption-based tax as opposed to a location to where all the capital is being deployed. Next slide. Pillar 2 is the idea of the global minimum tax. And essentially, what the administration or the incoming administration is worried about is that if the US starts to incentivize the US or to attract US investment to build manufacturing facilities, to have state-of-the-art manufacturing here, think bonus depreciation, think the Trump idea of a special manufacturing tax rate, think about the reintroduction of R&D credits that would actually drive down your effective rate here in the US to say 8.5% from these tax incentives. Well, the whole idea from a global international tax incentive under the Pillar 2 would be that if they attracted, the US attracted a foreign country to come and invest and build manufacturing facilities here, state of the art, that there would be what we call a top-up tax, in that under Pillar 2, you're only paying 8.5% here in the US, but unfortunately, you would have to pay, the foreign company that's coming into the US would have to pay a top-up tax into country A, so that there's no incentive to come and invest in the US from that perspective. Next slide. So higher tariffs and lower income tax is what we think we're going to see. Originally, we were thinking, and it's still very early on, but when Robert Lighthizer was the big bet to be nominated as US Treasury Secretary, who had a lot of economic work behind the things I just said, a lot of people believe that if Lighthizer was going to be the US Treasury Secretary, a lot of people thought that tariffs would be more of a sort of a hammer, and that it would be a foregone conclusion that you would have tariffs. I think with the nomination of Scott Bessert as US Treasury Secretary, I think we're looking at Scott thinking, or candidate Bessert thinking, that tariffs will be another arrow in the quiver. You know, it'll be a tool. It'll be a primary tool in trade negotiations, but it doesn't necessarily have to be a foregone conclusion that tariffs are going to be used. I mean, we're, I think, used to Trump's rhetoric, but behind that, how are they going to do it? So tariffs and the OECD pillars, what are we seeing? I think Pillar 1, under Biden, it was likely dead. I think there is no doubt under Trump that Pillar 1 is dead. And the reason it's dead is because it takes at least 30 countries to sign on to this, the countries that would be most impacted. And we just do not foresee the US agreeing to Pillar 1 and that. What we will have to deal with, though, is digital services tax. And that will be a concern for US technology companies, I think, going forward. Pillar 2 is we really think that with this undertax profits rule, there are many countries like the UK and Canada that are set to have the UTPR coming in 2025. We really think that the administration will use the tariff idea to negotiate or could use the tariff idea to negotiate with regard to avoiding the Pillar 2 minimum tax coming into play. Next slide. And we have seen, just to let you all know, in 2023, there was potential U.S. tax legislation put forward by the Republican House Ways and Means that did, of course, it got out of committee, but it went no further. But we do think that there could be legislation that's anti-OECD pillars coming forward. We'll see how that works. I think you've already heard. Will we have one reconciliation bill? Because in the past, we've only ever had one reconciliation bill. There's never been two reconciliation bills that's gotten through. Or will the new administration try to have two reconciliation bills to pass tax? That is a wait and be seen, and very interesting to see how that takes place. Next slide. Future of the U.S. international tax provisions. Just a very short summation. Under GILTI, it's currently very beneficial at 10.5%, scheduled in 2026 to go up to 13 1/8. We think that Trump would want to keep that at 10.5%. We think FDII, which is an export subsidy, we think the Trump administration would want to keep that incentive because it's very manufacturing beneficial. We think that the BEAT, however, the base erosion deal, we are hearing, or at least from my conversations with people I know, that could be a trading tool and that could actually go up to 12.5%. It's all preliminary. We'll have to wait and see. Corporate AMT, we'll wait and see. Early indications is that there's a desire to repeal it, but there's a long ways to go through this legislative process. So we're just getting started on international tax. There is a lot to come, and we are heading into a great, I think, 6-8 month cycle here to see how it's going to all play out. Next, polling question number 4. Would you like a team member to reach out to you after this webinar to learn more? And I think at this time, I will turn it back over to Ron.
All right, we'll give the poll a few more minutes. In the interim, I would like to thank you for attending. We always want to be respectful of those that have joined us today. Again, it was in excess of 700, but we want to make sure that we end at top of the hour. So we hope that we provide you from a look forward, or what's often referred to as state of play, what we're looking at, not only from a potential permanent and or extension of the Tax Cuts Jobs Act of 2017, both on the individual side, on the corporate side, and most importantly, on the international side. I do want to make sure that I thank my fellow colleagues and presenters, starting with our managing partner of tax, Brian Moore from Cherry Becker, and then Sarah McGregor, who did the individual, the 199 Cap A, or the qualified business income piece, and then Martin Martinez from a corporate tax, and then Brian Dill on an international tax perspective. Please feel free to reach out to any of us with respect to questions that you might have. I am required to give you this disclaimer. Certainly, we talked a lot about what could happen, but we do not know what will happen. I think there are some guardrails in place, starting with the trifecta of the President-elect Trump, obviously the flip in the Senate from a Republican standpoint, and then the continuing majority in the House. Both Senate and House have what we would be perceived to be some thin majorities. But as you can see, that budget reconciliation, as well as what, from a Republican perspective, are they willing to potentially increase the debt? Those are things that will be very important to stay on top of. So let me thank you again for attending today. Got one minute left. Please feel free to reach out to any of us, starting with myself, as well as Sarah and Brian and Martin. I would like to say that we will have a second and likely a third webinar as things will continue to move more on an accelerated pace. We'll see what the meetings hold. I'm fortunate to serve on a number of national committees with respect to tax legislation, tax policy, 174, et cetera. And so we will see what this weekend holds and where President-elect Trump is in regards to potentially two budget reconciliations or one. I think right now they seem to be leaning, based on Senator Thune's comments, to basically debate whether it's one or two. Speaker Johnson's on the two side, and Senator Thune on the Senate side is one. So we'll keep you. So put January 15th on your calendar, please. Another CP event for you, and we will continue to update you. We will have different speakers. We will have the head of our state local tax team, state and gift, and others that will keep you apprised of. So again, thank you for joining us today, and great to present to you all. Thank you.